45. Hmm. And Rob, in Minnesota this week?
Fusion 24, which is a company that helps credit unions do mortgages, commercial and residential. And so they have a annual users conference, which is in, Minneapolis or Bloomington. And the other night I walked around the Mall of America, which was interesting.
There you go.
They're hiring at the Museum of Illusions.
Were you wearing your halo at the mall? It really does look like a halo. Now that I
I,
look
I
at it, you look
attracted a lot of attention.
look very angelic.
Yeah, well, the robe and the wings didn't hurt.
All right. Well, welcome everybody. I'm Rich Swerbinski with Onward and Upward Consulting. This is the big picture. Thank you for joining us. This special edition this week. Really pleased to have a special guest in the wake of not only presidential election, but a Fed rate announcement. We'll get into all that momentarily. Let's start with some intros. As always, pleased to be joined by my esteemed colleague and co-host, the very angelic today, Rob Chrisman. Rob, good to see you.
Trying my best.
And if you're listening on the podcast, Rob's got, some sort of lighting apparatus above his head that looks very much like a halo, hence the angelic jokes. And our special guest today, very, very pleased to be joined by the president of the MBA. It is our friend Bob Broeksmit. Bob, thank you for joining us today.
Happy to do it, Rich. Good to see you.
All kinds of stuff going on. We have a new show sponsor here on the big picture. Want to give a big thanks to Gaffney Austin. You can see in the chat some information about Gaffney Austin. You can visit them at gaffneyaustin.com. They are a marketing and public relations firm for the mortgage industry. Firms that are interested in communication strategies, outreach tools, interactive messaging, ways to kind of support or garner media coverage. Visit them at gaffneyaustin.com and really, really pleased to have them on as a show sponsor. So there we go.
Yes, thank you very much.
And Rob, I mean, so many places we could go here. Obviously, the Fed just cut by 25 basis points, unanimous move. You're looking ahead to December, 35% chance right now of another 50 basis points in December, 65% chance of another 25 bips in December. So we got the Fed move and news out there. And then obviously the presidential election, which I'm just happy that it wasn't close. We have it in the rear view. We're not under martial law. And we have a new presidential administration. So I'll let
Coming
you
in.
Coming in and a new old, and I'll let you decide where you want to take this thing to get started today.
Well, I wanted to, we can talk about the implications of the election on interest rates, which we saw yesterday, or the regulatory environment. But I think we'll save that for a little bit. The Fed move, interest rates are interest rates. The events that I've been to recently, it's kind of, people are beat up a little bit by the rate environment and the optimism that we saw a couple months ago in September with the 2-day refi boom has virtually vanished. And so people, I think, are, I won't say dejected, but very pragmatic heading into the winter season, hoping purchases would pick up a little bit, but we'll see, late autumn, winter, early spring. It's going to be a little bit tough, I think, for some companies. But I want to take a step back a week, Bob. It's already been a week since the annual convention and expo wound up in Denver. And I wanted to hear your thoughts on attendance. Was this better or worse or kind of the same from a quality perspective from other annual conferences that you've been involved with, and just see what you thought overall?
Sure, Rob. Well, I'm not an objective bystander, so I take this for what it's worth. But we had probably 15% more attendees than we did last year in Philadelphia, so we were close to 4,000. So we thought that was great, and I've heard tremendous amount of positive feedback, both about the sessions themselves and the opportunity for people to very efficiently meet with so many of their clients and professional acquaintances, because the attendance was really good and a lot of really important connections were made or or rejoined. And I'll take a point of privilege for a second and say that as CEO of the MBA, one of the perquisites of my office is I get to interview some pretty interesting people. And I'll tell you, interviewing John Boehner from the main stage was certainly a highlight for me. And I'll let our listeners in on a little backstage conversation I had with him. We, as you can imagine, had very carefully crafted about 15 questions I had on big index cards and vetted with his staff. And yes, they'd be okay. And just before we go out, he says, "Hey, I don't know how you're going to handle this, but if I were you, I'd ask, how'd I get into this crazy business? I'll riff for a minute or two, and then you can ask me whatever the hell you want." So that was the setup. And I think it was a really great session and very insightful on Boehner's part.
Well, I will agree. I thought, heading into that conference, I had flashbacks to the conference that we had in San Diego some years ago, where you literally could have used a bicycle to get around. There was so much walking, but kudos to the team at the MBA, especially Marcia, who put this on, because I thought the conference center, even though it was 2.2 million square feet, I thought having the registration desk up like right by the front door,
Yeah.
and the exhibition hall right above that, and then the meeting rooms behind that, I thought it was very well laid out and very efficient and made for not a lot of travel time if you didn't want it. So hats off to that. What is John Boehner doing now exactly? And tell us why you picked him to address an MBA conference.
Sure. Well, Boehner is a lobbyist with the law firm of Squire Patton Boggs, and he is, I'm told, I didn't look it up, but frankly, one of the keys to that interview I did with him is I did very little preparation. I know a lot about the topic. He knows 10 times more, and we just had a conversation. But I'm told he works on behalf of some Indian tribes, and while Boehner is known as a chain smoker of, as far as I know, tobacco cigarettes, he's also representing some firms in the cannabis industry. So, but in terms of speaker selection, what we find, and he certainly fit the bill, is that if you get someone who has been in the seat and been through some of the same cross currents that are going through the Republican Party and the Congress writ large, but he's no longer in the seat, you get a much more frank perspective. So that's why you'll often see recent former, or past chairs or past heads of things, because they'll tell it to you the way they really think it, as opposed to couching it in Washington gobbledygook.
It's interesting to what happens to some of these people who had a fair amount of authority. Not, I mean, we're going to talk about the election, I'm sure, but at some point, Kamala Harris will be in that position. Does she go the way of Dan Quayle or John Boehner or Newt Gingrich or Walter Mon? It's interesting to see where they go from here. So congratulations on John and having a good session there. But yeah, as Rich mentioned, we just had an election, so I've heard. The results came out, seemed fairly straightforward. And you and I kind of travel in some of the same circles, and you've talked about potential fallout or potential ramifications of each candidate leading up to the election. Any surprises from your perspective the other night?
Well, let me start with a dinner I had with the founder and chairman of Real Clear Politics precisely 2 weeks before the election on a Tuesday. He showed two charts, and I knew when I left that dinner that the election was over. One is that every election since 1948, the issue identified as the top issue, so let's say there's 8 issues people care about, the one that gets the highest percentage is the top issue, which of course this time is the economy. And then the question is, which party would be better able to help with that problem? And while Trump's lead over Harris vacillated some, it was always at least 5 points, right? In how you would handle the economy. The person who scores the best on the issue that's the number one issue in that election wins every single time. And that held here, obviously. The second one is that they survey people and say, which party are you a member of? And if you're not a member of a party, which way do you lean? Do you lean left or do you lean right? And so they take all the registered Republicans plus right-leaning independents, and then compare that to the Democratic Party members and left-leaning independents, and the delta between the two. So that was a Republican plus 2 weeks before the election. So I don't know if it was 51-49 or whatever the spread was. You then look at the difference in the popular vote. This dates back to 1980, every election. And the difference between the party affiliation and the popular vote is usually within 1 percentage point. In other words, if it's R plus 2, that means the Republicans are going to win the popular vote by about 2 points, give or take a point. Guess what just happened? They won by 2 points, and that was the spread. It's extraordinary, the correlation. So I was not surprised. It's a long answer to a short question. Was not surprised that Trump won, and certainly not surprised that the Republicans took the Senate. Sherrod Brown has persistently been able to win in a what was once purple and now red Ohio, but he's never been on the ballot the same year as Donald Trump. He could not withstand that this time. And similarly in Montana, Tester, Trump was going to win Montana. I didn't look at the final results, but by 40 points or something. And it's really, really hard to find enough ticket splitters to be returned to Congress. And that's all they needed. And we'll see where the Pennsylvania race goes. McCormick is up, but there's still some votes from Philadelphia to count. So I sort of think McCormick will take that to give it a 53 edge in the Senate, but others think that Casey will hang on and it'll be 52. The House, okay, I'm finally getting around to your question. The thing that surprised me is that even in states like New York and California, where the Democratic candidate typically runs up the score, the margins were tighter. Why does that matter? Well, for 2 reasons. One, it means that the popular vote went to Trump, and at the moment he's over 50%. So there won't be any, the Electoral College robbed us again. The popular vote went to Democrats. That's not happening this time. So that was a bit of a surprise. And the second is that there are some very close House races in New York and California. And by Harris having a lower margin than Biden did in those states, some of those things that some expected to flip from from red to blue, and therefore maybe control of the House, I don't see it happening. I think the Republicans are going to be in charge of the House too, and I did not expect a sweep. I expected the House to flip, frankly. I expected a double flip, Senate to flip and House to flip.
Bob, I should probably know this, but what Republican with Sherrod Brown out now, which was a shock here in Ohio, he was up in the polling pretty much the whole election, 1 or 2 points going in, ended up losing by, I think, 5. What Republican ascends to the Senate banking helm with him now out of the Senate?
Yeah, sure. Tim Scott from South Carolina.
Okay. Mm-hmm.
And Scott has been, as you know, he ran against Trump in the primary, but then campaigned for Trump. Mm-hmm. And I do believe that if Senator Scott wanted a cabinet post, he could, I don't want to say certainly, but I think it's pretty clear he could get one if he wanted one. But I believe he'll stick around because, running Senate banking is a pretty big job. I expect he'll stick around in the Senate now that the Republicans have taken over.
And he was the one, of course, Trump worked with on the Opportunity Zone initiative that they undertook during Trump's first term. So that's good to hear. I remember that. I think now it's good to hear you affirm that. So,
yes.
And Bob, so much more we want to get into with policy, but before we get into that, real quick, there's Rob. Your hands up.
Yeah, I'm not quite done, Rich. I'm not quite ready to move on. I know that Bob has an esteemed group of folks working for him, with Mike Frantoni and Marina Walsh and Joel Kahn. Bob, do you think that the economy is doing that badly, or were people just told that it was doing badly? Because I think wages have caught up with inflation or past inflation. Inflation has dropped. House price appreciation continues to steadily go higher. Is the economy bad enough? I mean, is it bad enough in your view to make an issue out of it when an issue actually was made out of it?
So I don't think anybody told the voters anything. I think they looked at their real life experience and said, when Trump was in office, a dozen eggs cost less. My 3% merit increase outpaced inflation. So I was actually gaining ground in real spending power. And the Biden administration did not take into account properly, in my view, how you cannot recover quickly from a year of 9% inflation. Everybody says, oh, gee, it's getting back down toward 2. Well, that's 2 on top of 9. It's not 9 minus 2, it's 9 plus 2. And so, yes, in the past year, wage growth has outpaced inflation, but cumulatively over his term, and you take it back to the Reagan question, are you better off than you were 4 years ago? And a very significant number of Americans said, no, I'm not. And I don't agree with everything Trump does, but boy, I felt better economically back then. And I had not an argument, but a conversation with my wife about this. And she said, Americans have amnesia when it comes to Trump. And I said, no, they don't have amnesia. They have a selective memory. And they remember the economic stuff being better. And they forget some of the, what would you say, some of the unorthodox approaches that he had to things.
Good answer. Thank you.
Bob, before we delve more into housing policy questions, issues, you've been in my LinkedIn feed a lot. You got a lot of stuff going on out there. Of course, I saw just today, I think you made some comments on the FICO price increase. We've, of course, got the trigger leads ban, that bill that appears close to the finish line. You put out some also commentary that was near and dear to my heart, the very old and antiquated and opaque Section 8 of RESPA. So if you could just give us updates on those things and where MBA is at with those initiatives, it would be awesome if you could.
Sure. On the credit report fee question, FICO put out a very lengthy blog last night announcing a price increase to $495 per score. They didn't focus on this, but where it has been is $350, and that was an increase of, quite substantial increase from the year before, but increased to $495. They, to their credit, they transparently said, here's why we're doing it. Now, you can disagree with the reasons, and we certainly have some issues with them, but at least they put it out there and said, here's what we're doing. The thing that makes, and you might say, okay, well, gee, $1.45 a score, you get 3 scores. Just for easy math, round it to $1.50, that's $4.50. If there's 2 borrowers on the loan, there's $9. If you run 2 credit reports, one in the beginning, one in the end, it's 18. Why is everybody so up in arms over this? Well, the problem is that in addition to FICO's scores, score price increases, there are 3 bureaus, as you know, and they have been completely opaque about their pricing structure and their reasons for increasing. And we fully expect that they will not just pass along dollar for dollar FICO's increase, but they will add margins of their own, so that if you have the FICO increase plus increased margins at 3 different bureaus, you're going to get a pretty significant increase in the credit report cost for the 3rd year in a row. And our position is that these are public companies or publicly traded companies. They can price their product however they want. But the problem is, as you well know, lenders have no choices. And not only do they have no choices, but they have no choices because the government itself mandates that the lender uses FICO for a credit score and the 3 bureaus for a tri-merge. And we think it's wrong that you can have a government bestowed a market position like that and raise your prices completely out of line with inflation. If the price of a credit report went up 3% year over year, I think there'd be a big shrug and a yawn. But we're talking Well, in FICO's case, 40%. We'll see what the bureaus do on top of that. And since there's no choice, it seems profoundly unfair. So we're recalling, we've already done this before, the CFPB and the Federal Trade Commission to look into this and see if there are ways in which the government, and by the government, I mean FHA, VA, USDA, Fannie, Freddie, requiring lenders to use these providers is driving up the cost in a way that's anti-competitive. And the other thing to know, which I'm sure our listeners know, but some in the broader public may not, is that this hurts the consumer because when the loan closes, the consumer pays these increased fees. But it also hurts the lender because I talked to one lender yesterday who said only 17% of the people for whom they pull a credit report end up with a closed loan. You know, the inventory troubles out there, or people, you know, you get the credit and you say, geez, you know, I really can't help you until you improve your score, et cetera. So 83% of those credit report fees are going to the lender, who has just eked out a profit for the first time in 9 quarters. So it's really a problem. And that's why we put out a strong statement and are urging restraint by the score provider and by the bureaus.
So Bob,
sorry, go ahead.
along those lines, I
Yeah.
have written about lenders who will charge for credit up front rather than on the tail end to help defray some of that cost. Have you heard any lenders who are definitely charging borrowers or potential borrowers up front to mitigate that? Or is it just kind of out there?
That's an option. You have to be careful on precisely when you charge so that you don't run afoul of TRID. But yes, that's out there. I don't think it's the norm, but it's out there. And the other way that lenders just can't absorb this when the margins are negative or very low, they can't absorb it. So if they don't charge the borrower up front, it just goes into their overall overhead, which has to be included in their margins, right? So consumers end up paying, and you'll see that some of the justification for the increase is, well, it's an extremely small percentage of overall closing costs. Okay, if I go to the grocery store and I pick up a bag of chips and the price goes up 40%, it doesn't make me feel any better that my bag of chips was only 3% of my total grocery bill. It's not a legitimate argument in my view. And when this has happened 3 years in a row, in a circumstance when lenders are suffering, affordable home ownership is becoming increasingly out of reach, and market participants are using their oligopolistic standing to pass along these increased costs, I think it's just wrong, and we're going to shout it from the mountaintops.
The trigger lead bill, Bob?
Yes.
Abusive trigger lead.
Abusive trigger lead bill?
Yes. This has been our top legislative priority this year. And while it may seem like nothing happens in Washington in the last few months leading up to an election, there's actually a lot going on, because there is a must-pass bill during the lame duck, meaning between now and January 20th, but typically before December 31st. That's called the National Defense Authorization Act. And I don't think ever in our history, even in the most polarized times, have the parties not come together and passed this bill. So it's extremely hard to get an individual bill passed in the Congress because of the floor time it takes and all the competing priorities. So the idea is, once you've done what we've done and gotten the House and Senate to agree on language on a bill to curb abusive trigger leads, and you have to find a moving vehicle to get it passed. So we're grateful to have worked with some key senators to get it attached to the National Defense Authorization Act and in what's called a manager's amendment. So when the Senate considers it, it will be in there. We are working with our friends on the Hill to make sure that the same thing happens in the House. We're working with Chairman McHenry of the House Financial Services Committee and Ranking Member Waters. We are optimistic that it will remain in the bill through the House side of the consideration and be signed into law before the end of the year. We never spike the football until the ink is dry, but we're very optimistic.
And then lastly, RESPA, which you put out
Yes.
some commentary on.
Yes, we put out an extensive paper on this. The occasion is the 50th anniversary of RESPA. So I guess, what is that, 1974?
Mhm.
And I don't know, I date myself when I use this metaphor, but some people still understand it. CFPB Director Cordray back in the day basically said he couldn't imagine a compliant way to structure a marketing services agreement. And I liken that to Ralph Nader calling the Corvair unsafe at any speed. So if you have a regime that contemplates a joint venture or some kind of an arrangement with, say, a lender and a realtor, or a lender and a builder, or a lender and a title company, and RESPA Section 8 tells you how to do that in a compliant way, and then you have the chief regulator of the Bureau saying, I can't picture a compliant marketing services agreement, seems like you need a new RESPA Section 8. So for that and other reasons, we are calling on the Bureau to take another crack at RESPA. We think it is completely opaque. We don't think that it is, well, 50 years old. We think it needs modernizing, and we think it needs to be written in such a way that consumers can benefit from these arrangements without lenders fearing that they'll be looking over their shoulder, and particularly when perhaps a certain administration, like let's just say maybe you got a wink and a nod from the Bureau during the first Trump term, and then the same agency comes in the second term and says, wait a minute, I got a whole bunch of questions about this arrangement. Yeah, businesses need certainty so that they can offer consumers choices and pass along better pricing, and to have it very clear to the consumer that they can opt out, right? They can say, yeah, I'm glad that it would be a simpler process with your affiliated title person, but I used this other guy last time and I liked him, and I'm going to do that. That's absolutely fine. But the rules of the road need to be clarified in a really real way, and we don't really see how to do that without rewriting RESPA.
So Bob, in a situation like that, when the CFPB is involved and residential lenders everywhere through the MBA, do you envision the CFPB kind of doing it on their own, or have you given the CFPB points to improve upon or rewrite?
Sure. No, we're always there for helpful feedback. So we'll say, here's the problem with how it's written today. Here's how we would suggest it be changed. And then, of course, the drafting is up to the Bureau. But one of the hallmarks, I hope, of the MBA during my tenure, and probably long before, is that we don't just kvetch and say, hey, something's messed up. We say, here's the problem. Here's what we think is important to you as the administration or whoever we're appealing to. And here's a way to get there that lenders could actually implement and help consumers, as opposed to just saying, this is all screwed up and I wish you'd fix it.
Wouldn't it be nice if kids everywhere had that outlook too, instead of complaining about something to their parents and then expecting their parents to figure it out? Complain about something and then give their parents a potential solution.
Yeah, well,
to
at least we can give them some grace and say they have adolescent brains that aren't quite as fully developed. For grown-ups, I don't know what our excuse is. So
Yeah, I don't know if Rich told you that half our audience is typically from the CFPB, but don't worry about
it.
Bob, you took over as MBA president and CEO in August of 2018. Couple years left in Trump's first term. I guess just any, thoughts on just your dealings with his administration. It was Calabria and Carson and Mnuchin was the crew, right?
Yes,
Mhm.
Kathy Franinger.
Kraninger,
Who
yes,
took
at the
over
Bureau.
for Mulvaney, I think was the first appointee
Yeah.
at the CFPB, who famously called the CFPB a sick, sad joke at one point, and then was appointed as the director. But just your thoughts on, I guess working with the administration, things that might be easier, more difficult, maybe some things that wouldn't need Congress, and could be done for housing through executive order shortly into the new year.
Sure. Well, as it relates to FHFA, no matter who the head is, because of the recent Supreme Court decision that said that the structure of the Bureau was unconstitutional when the director, it was a single director and could only be removed by the president for cause, and that the way to make it constitutional was to have the director serve at the pleasure of the president. That eliminates any pretense that it's an independent bureau. This is the same with the CFPB. They were different court cases, but same result. And so when they were both set up, you'll remember that the director has a 5-year term. Why is 5 years an interesting length? Because it, by definition, crosses over presidential terms, and it's meant to insulate it from some of the politics. Well, now that those directors serve at the pleasure of the president, the bureaus can whipsaw, the CFPB and the FHFA can whipsaw starting January 20th as anytime the party in power in the White House changes. So what that means is that you tend to get, as opposed to a long-term steady approach by the GSEs on a certain topic, you may see them, as we have under Sandra Thompson and President Biden, really lean into their mission and their affordable housing goals. They created equitable housing finance plans. They focused on their duty to serve, and they de-emphasized by increasing the loan level price adjustments on things that weren't as mission related, like second homes, investment properties, high balance conforming, with the rationale that the private sector can do some of that lending. On the Republican side, I don't know who the new FHFA director will be, but I can almost guarantee you it will be someone who thinks that the government should have a less expansive role in the mortgage business, and that Fannie and Freddie should not remain in conservatorship forever. It's been 16 or 17 years, I forget which. And they've been building capital now for several years. And while they're short of their goals, it's not crazy to think they could be brought out of conservatorship subject to a consent order that says, well, you're under a consent order until you hit your capital target or something like that. So we've been thinking about this for a long time at MBA. We have a board level task force assembled and working. It has been working for months to make sure that we pressure test our previous white paper on GSE reform. We consider things that can be done by FHFA as supervisor, which they'll continue to be, as opposed to only with their conservatorship powers. If there are anything that are practice today but not law, can we get a rule written to make sure they stay in place, like a level playing field for guarantee fees, for instance, regardless of volumes? And the other piece is that any discussion between FHFA and Treasury, which are the two key dance partners on any ultimate release, involves some kind of guarantee on the GSE securities. Because if the result is that Fannie and Freddie come out of conservatorship and their securities have no government guarantee, we think it could be extremely disruptive to the market, and that Fannie Freddie loans would be priced worse than private label security loans, which would be a terrible outcome, I think, for the country.
Yeah, I agree, Bob. What in talking to my capital markets cronies, the thinking is that Fannie and Freddie rates would go up, 1 to 2%, without some measure put in place so that they don't. Getting back to the personnel, I know that there are certain positions that serve, quote, at the pleasure of the president, and others have fixed terms. I know that Rohit has a finite term. It's due up in a year or two. The same with Fed Chair Powell, Michael Barr. As the SEC head, I think has a date in the future. Assuming that Donald Trump is going to make changes right from the get-go, do you see his old crew coming back in, let's say, to the CFPB? Or do you think he'll mix it up a little bit?
Well, yeah, I think, as I mentioned, Chopra has a 5-year term, but it's meaningless because he serves at the pleasure of the president, and he would not please the president on January 20th. So he'll be out day one. I have not spoken with Kathy Kraninger, but I'm sort of assuming she likes her private sector role and would not want to come back for another term, but I don't want to speak for her. And I think it's more plausible that you might have had others who were at the Bureau in deputy roles or roles like that who might like to come back and get a chance to run the thing. So that wouldn't surprise me at all. And as it relates to FHFA, I'm and I'm not making news. I'm quoting the news media and saying that Jonathan McKernan is a name we hear a lot. He's certainly uniquely qualified. He was on Senator Corker's staff during Corker-Warner. For any of you junkies on GSE reform, that was an effort with Mark Warner of Tennessee and Mark Warner of Virginia, Bob Corker of Tennessee in the Senate to broker a deal to bring them out of conservatorship. It didn't get across the finish line, but McKernan was involved in that. He's been at Treasury, he's been at FHFA, and he's currently an FDIC board member. And I presume would be interested, and I think would be the kind of person that the Trump administration would consider strongly.
So wasn't John Warner married to Elizabeth Taylor?
That was John Warner. Mark Warner, the other Virginia senator, that yes, they had two senators named Warner. This was Mark Warner.
Okay.
But
I'll
yeah,
stand down now.
He was.
I was going to have to search through People magazine archives for the answer to that one. So thank you, Bob.
Well, extra credit if you know which of the 8 husbands he was. I think he was about number 6, but I'm not sure.
And then Bob, to Joe, mortgage lender out there listening, expecting maybe some regulatory relief. Not going to get an unwind of Dodd-Frank, obviously. But with Trump, in office and are going to be in office, and the House and the Senate both Republican now. Just any thoughts on what deregulation for the mortgage industry could look like in the next year or two?
Sure. Well, you've heard me over the last year or so saying how lousy the Basel III capital requirements would be for the mortgage business, both in terms of risk weights on high loan to value loans on bank balance sheets, the treatment of servicing from a capital perspective, and the treatment of warehouse lending. All would be extremely damaging to our industry. And certainly Trump's election stops that in its tracks. We, along with others, had done a great job in pausing it. And you heard Michael Barr say a month ago or so that they would repropose it. It hasn't even been reproposed. Director Chopra, in addition to being at the Bureau, has a seat at the FDIC, and he's been blocking it over there. But it means it'll never see the light of day in anything like the form it was in when it was proposed. So that's a very positive outcome of this election. You'll also see when agencies have the discretion of whether to pursue. Of course, they'll be vigorous supervisors, as they should be, right? We want fair, vigorous supervision, but I think you'll see a much more constrained view of what is in their purview. The Bureau, using my Harvard friend Rohit Chopra's vocabulary, like to use dormant and latent authorities. Like, well, geez, don't you have enough express authorities? You got to go looking for dormant and latent ones. And you saw him getting his nose into everything. And I do not think you would see that in a second Trump CFPB. And when there's a jump ball in terms of some kind of supervisory or enforcement matter, I think the tip will more often go to industry than it has under the current administration.
And then the home builders, Bob, so much talk about the home builders, the cost of regulation, permitting, just red tape that makes it nearly impossible for a home builder to build something in America under $450K. Seems like it's a bipartisan issue that should have support, but maybe your thoughts on what we could see in the home building realm in terms of relief early into the Trump term.
Yeah, this will be very top of mind for us this year for a lot of reasons, not least of which is that our new chair is Laura Escobar from Lennar Mortgage, one of the biggest home builders, if not the biggest in the country. And she used some of her time during her acceptance speech in Denver at our annual convention to highlight some of those points about the enormous cost of government red tape, permitting, entitlement process, delays, it's not free to buy land and then let it sit there for a year before you can put a spade in the ground. So anyway, yes, that'll be very top of mind for us, housing supply. And one of the things that was gratifying about maybe a not that inspiring presidential campaign this year was that both sides talked about how important housing was, how housing affordability was a key issue they kept hearing again and again on the campaign trail, and how housing supply was at the root of it. So you heard Vice President Harris, along with her, what we would have considered a demand stoking and therefore not the best policy, $25,000 down payment assistance. She also had ideas about how to build more homes by using the tax code to incent builders to bring things online at prices that would be affordable at, let's say, I don't know, 80% or 100% of area median income, that place where it's so hard to find good quality housing. And using the tax code to do that, let's say somebody does the math and says, all right, well, I'm going to build 40 houses on this piece of property I own, but they're going to have to be priced at $495 for me to make an acceptable return. And if you could use the tax code to say, well, you could sell it for $375 and that's affordable at 100% of AMI, I think that might have been a pretty appealing way to use our tax code to attack a real pressing national problem. So I'm hoping that the Trump administration and this Congress would also be open to those sorts of solutions, because if it doesn't increase the supply, it does not get at the root problem.
Of course, Rich, as you know, there's the Sierpinski plan, which has been floated they're Ira chiming in, shortened to the SWIRD plan, but yeah, where you would give a tax break to sellers of homes if they were selling them to first-time home buyers.
Yeah, it's I'm proposing for about 7 years now, a 6-month window where non-institutional owners of investment properties waive the capital gains taxes if they sell to an owner occupant. What say you to that plan, Bob?
What's wrong with institutional sellers as well, Rich?
Well, I'm just trying to be realistic. Anything gets beat up and beat down before it gets put into law. So
True.
Well, in true Washington fashion, I'll answer by giving you another idea instead of directly answering your question. We think, and I see it in my own neighborhood, I'm sure you all do too, that when you have people who've lived in a house for decades, or it doesn't really matter how long, but just for, generally speaking, for a long time, and they are ready, willing, and able to downsize or move into a retirement community or move into their second home full-time, or whatever the circumstance is, this notion that $500,000 is exempt from capital gains on the sale of a primary residence, but no more than that, and that's if you're a married couple, it's $250 if you're single. That hasn't changed in, I forget, 20 years or something. And doubling that to, let's say, $1 million, and then indexing it to inflation, I think would free up a lot of housing supply. And there's a bipartisan bill in the House that we have supported. It's Jimmy Panetta in California, and I think Jimmy Gomez may be on the other side. Anyway, I forget exactly, but I know Panetta's involved. And so, like you say, everybody will poke holes in every idea, and some people will say, well, geez, if you have $1 million capital gain, I'm not crying any tears for you. But the fact is that if you wait until you die, your heir doesn't pay any capital gain because you get to step up to the basis. So let's think smart about how to increase the supply. And that's something, I mean, of course, it'll have to be reintroduced in the new Congress, and to the degree that there is a cost associated, President Trump has made a lot of very expensive promises on the campaign trail, in addition to just extending the Tax Cut and Jobs Act, the Trump tax cuts that expire at the end of 2025. No tax on tips, no tax on Social Security, no tax on overtime, giving you an interest deduction on your car loan, and bringing SALT back. Well, all great depending on what part of the country you're campaigning in, but they all have enormous price tags, and the price of just extending the expiring cuts is in the trillions. So It's not going to be easy to get more things in that reduce tax revenues, but it'll definitely be in the conversation.
We've run out of time, but Bob, to your point, I've heard that any change to the SALT cap would cost the United States over $1 trillion, like $1.2 trillion.
Well, and the thing is that if you live in New York, New Jersey, California, I'll throw in Maryland because we're certainly a high tax state too. Most of the benefit goes to people who earn a decent amount of money. And the people in those states say, well, you have to earn a decent amount of money to live here. But there are some who say, you know, as you know, Biden and Harris had this magical, if you make more than $400,000, you can pay more. And the SALT thing generally benefits people who make more than that. So yeah, it'll be a debate, but when you have a very closely divided House and Senate, a caucus of people from those states can have a great deal of influence. So I would keep my eye on that one.
Yeah.
Bob, I want to thank you so much for coming on the show today, sharing your insight with our listeners. This was fantastic. And yeah.
And thank our sponsor as well, Rich.
And to thank our sponsor, yes, Gaffney Austin, marketing and public relations firm for the mortgage industry. You can visit them at Gaffney with 2 F's, austin.com. And if you need some help with communication strategies or strategic outreach, interactive messaging, they do that for a lot of firms in the mortgage industry. So thanks to Gaffney Austin, and thanks again, Bob.
All right, Rich and Rob, great to be with you.
And thanks to our listeners. And as always, we're here live at Thursdays at 3 p.m. Eastern, and then we go right to podcast and YouTube. And if you're watching or listening on one of those mediums, join the live show. Go to chrismancommentary.com and you can get signed up. And I want to thank you all for spending part of your Thursday with us. And
Yes,
we'll
thank
see
you.
you next week.
Thank you, Gaffney Austin. Thank you, Bob.
All right, so long.
Take care, everyone.